Hi, everyone. Happy Monday. Welcome back to the Main Management Weekly Market Note podcast. I'm James Maxwell, VP of Research here at Main.
And I'm Alex Dippery, research analyst.
Great. So we'll go ahead and jump into it. First, here with performance for the trailing week, you have you can kind of see the bars there. Pretty risk on week in terms of the sectors. You saw tech lead the way up 3-2. On the bottom end there, actually interesting, you saw two defensive sectors, utilities and consumer staples, were down the most at 0.9 and down one spot 4 respectively. And you also saw consumer discretionary down there. I think there was some of that was just off of Tesla and the kind of mayhem last week. But regardless, you kind of very much saw a risk on week as you continue to march higher in overall markets.
Yeah, and you also saw a decently strong week for commodities, which was reflected in energy and materials as well.
Yep, absolutely. Recession dashboard, nothing changed. Actually, was there any? No, nothing changed this month, and so we'll just leave it there. I think, unless you have any comments.
Yeah.
Non-farm payrolls was the big thing this past week on Friday. They came in at 139,000 above forecasts for 125 to 130, which was good to see. The market certainly liked that. However, on the kind of bad parts of the report, there were considerable revisions for the prior 2 months at a combined 95,000, which you saw hurt the April and March.
Right.
And on the unemployment side, it actually remained at 4.2 rounded. I think if you go to like the third or second or third decimal, it ticked up slightly, but at a rounding of 4.2. And then labor force participation declined to 62.4. So overall, it was not a bad report. I think there was a lot of kind of fear out there that it was going to be some start of the crash, start of some slowdown. If you look at the trend so far this year, it kind of confirms what you've already seen, that the labor market is moderately slowing, kind of gradually slowing, if anything. You kind of have to look through the tea leaves to even see that. But yeah, it's not any sort of crash, which I think there was some worry about.
Yeah, I will say one thing with this number, as you mentioned, the initial market reaction was pretty positive, better than feared.
Yep.
There is some concern that a relatively good headline number is, for lack of better words, sort of putting people asleep at the wheel when it comes to some of the marginal weakness in the labor market. So those revisions are one thing. There are certain age groups of the U rate that are higher than they should be. Specifically college grads, recent graduates, and so there are definitely some weaker parts of the labor market. But a decent headline number sort of makes it tougher for the Fed to cut.
Yeah, it makes it easy for them to just say, okay, well, we're going to wait another month, or just keep waiting to see if there's actually anything kind of absolutely material.
Yeah, and they've made it pretty clear that inflation is really what they're prioritizing. So unless there's some serious headline deterioration in the labor market, you probably won't see much from them. But you'd hope that sort of it doesn't go south fast, which is what can happen.
They're sitting in kind of the reactive camp rather than proactive. I would say most of the members are. They've kind of said this in the Fed speak, is like they're just waiting and seeing, and they're kind of openly not trying to be that proactive Fed, because ultimately I think they don't want to be responsible for any acceleration in inflation or even be possibly blamed for that. So even if there is sort of gradual weakness in the labor market, they're not going to be proactive in trying to prevent that. Kind of like, and if you look back to last year, that's kind of what they were doing, was moving down. I think it was the total 75 basis points of cut, the few cuts that they did. A lot of that they communicated as being proactive, and then that kind of has since dried up in their commentary. Regardless, moving to the wages and kind of a industry breakdown of the jobs report, you saw that wages were up 0.4% month over month, which is a strong reading. this we view pretty positively. It continues to allow for consumption growth on the consumer side, which, as you've seen, has driven a lot of the kind of overall GDP and economic growth. That's running about 3% annualized rate, even with all of this kind of tariff news and slowdown discussions. Looking purely at the consumption side of things, it's doing kind of what it's done for the past few years, largely driven by those real incomes, which we continue to see here. On an industry basis, there's not a huge, and there's not anything huge to see here. Education and health services led the way, followed by leisure and hospitality. So very much those kind of service-based jobs, and manufacturing was down. Temporary help services was down.
Yep.
Anything else to add to that?
No, I mean, I think the increase in wages is good. As you said, it's really encouraging in terms of consumer spending. That was really the main fear with tariffs, is that all of a sudden the consumer would sort of freeze, and that hasn't happened.
Yep.
And this is something that'll give just an additional tailwind to the consumer.
Yep. Yeah. Relating to that, we also got the JOLTS report, which is the Job Openings and Labor Turnover Survey. And essentially this tracks, it's about a month delayed from the non-farm payrolls, but gives you more granular data on exact openings and hires and quits and layoffs by industry. So it's just giving you more detail for prior months, and you're able to kind of get a better understanding of what happened, even if it is lagged. And it's telling a very similar story, which is nothing's falling apart, kind of moderating overall. You kind of see this slowing overall, but on a kind of month-to-month trend, there's not a huge signal from this.
Yeah, I would say one concerning element, and as we mentioned a few slides back, there are some weaker parts of the labor market. And when you start to see declining quits, rising layoffs, even if it's at the margin, that is something that is concerning. It's indicative of a tougher labor market, and so that's something that we'll want to continue to monitor, and just track closely.
Yeah, and if you also look at on the next slide here, we have the industry breakdown, kind of growth in openings and also by layoffs year over year. At the high end, you have information technology, which has grown considerably year over year in terms of job openings. I think if I were to guess, a lot of that is off of a smaller or like depressed base, where you've seen a rebound in a lot of the AI, tech, etc. type of labor market. Another interesting point to note on the layoff side, you actually seen a decrease in layoffs, meaning fewer layoffs in the government sector. That's amidst all of the headlines of kind of Doge earlier this year and trying to have those government layoffs, which for the most part have been coming in lower than kind of expected or announced. So moving on, we also got the trade balance data. This is one of those things to look at to really, really see the impact of tariffs. And you can really see that imports number considerably dropped in April. A lot of that was because of the kind of pull forward of demand, especially on the import side. Companies and consumers were buying things essentially before the tariffs were set to take place, so that they didn't need to do those same orders in the month the tariffs took place. So March and February rocketed up, and then April subsequently dropped considerably. So I think this just reiterates how noisy this data can be, especially when you have these huge announced events and then subsequent kind of revisions and changes to the tariff code. And
yeah, I mean, as you can see on that chart on the left, it essentially reverted back to its pre-tariff trend. And something to mention here is that this will bleed into other macro data, especially GDP readings. So you sort of have to look past that distortion when you're interpreting macro indicators going forward. The next couple months at least.
Yeah. More specifically, looking at the kind of goods imports, this breaks it down, but autos, you've continued to see, you had a lot of front running in the autos space where people were buying cars before all the tariffs came in, and then have really, really slowed down after that. But more broadly, telling the same story that you basically have a lot of distortion from the tariffs month to month, and it's hard to get a broader signal just from looking at April. Moving to the productivity numbers, we got the final reading for that. It was actually revised down from the previous reading and is now at down 1.5% quarter over quarter. This kind of runs contra to what we've said, which is that we expect productivity to grow above trend over the next kind of 5 years.
Yep.
A lot of that is from things like AI productivity gains, broader kind of efficiency gains, even outside of AI. I don't think that this reading necessarily, proves that wrong. It's one quarter on, out of, call it 20.
Yeah.
And with this measure, especially, and we'll see this on the next slide as well, it can be very distorted by the inputs. And if we've kind of seen anything the past couple of months, is that there are a lot of distortions happening. It's almost like a COVID type of
absolutely
COVID type of environment where you get sudden like start and then stop, or stop and start of an economy. Similarly, if you have a stop and start of trade, like there's going to be a lot of kind of weird distortions across the data unpredictably. So this isn't necessarily a bad thing, just something to keep an eye on.
Yeah, one other thing to mention here is the increase in unit labor costs. This is a big input in inflation. And in previous weeks, we've talked about sort of the concern of inflation expectations being elevated and that bleeding into actual inflation readings. And this is sort of how you would see that happen. People are expecting inflation, so it materializes in this sense. So hopefully that should come down a bit, as inflation expectations also should come down. But that'll be something to watch as well as we're thinking about inflation going forward.
Yeah. Speaking on the productivity part, the other two kind of things that you saw as part of this report were hours worked and then overall output. And just to kind of discuss how this productivity number is calculated, it's actually kind of a residual calculation because it's hard to measure, like, what is productivity. That's a very hard thing to actually measure. Essentially, what they're doing in a simple explanation is looking at how many hours are worked, looking at total output, and the kind of unexplained part is that productivity. Like how much more efficient are people with their time working? So it ends up being this kind of residual kind of call it result of a calculation of actually like real calculatable inputs, hours worked and output. So those two were both actually revised up from the first estimate. So this shows that like it's not everything's falling apart. It's probably more of like a data discrepancy, data kind of funkiness.
Right.
Anyway, so moving to the CEO confidence, that was another reading that came out for Q1, or for Q2. It dropped to 34, where 50 is neutral. A 26-point drop from Q1, and this is now the lowest it's been since Q4 of 2022. So absolutely a massive drop. I think the largest on record, or back to 1976 when the survey started. One thing to note on this, just to put things in perspective, that the last time it was this low was Q4 of 2022, which I mentioned. That coincided with the equity bear market. That was around October 12th when we bottomed there in the S&P 500, and things seemed extremely bleak. A recession was pretty much guaranteed, quote unquote, at that point, or forecasted to be guaranteed, and kind of saw this price and proof thing, which is sentiment was at a extreme low. All of these indicators were at an extreme low, and at the same time, the stock market, which is forward looking, started to rebound going into the end of 2022. And I think you kind of saw something similar here, maybe not to the same extent, but when they did this survey, which the survey period was from May 5th to May 19th, things looked bad, right? Like April, it wasn't maybe as bad as the low in April, but things definitely looked bad. And over those 2 weeks, you kind of saw an improvement in a lot of different areas, especially on the trade negotiations front. There's actually an interesting point that we mentioned, which is if you look at responses recorded before May 12th, which was when the China trade deal was kind of announced, and then look at responses after, you saw a very considerable increase in optimism from those post trade deal discussions. So basically, what that tells you is that a lot of the pessimism in this reading is off of things that are now out of date or less relevant, and also in such a quick moving environment. Even like a week difference in timing of a survey is going to result in a very, very different reading of how CEOs are feeling.
Yeah, I mean, essentially, this survey reflects the uncertainty of that time.
Yep.
It's easy to forget because it was about a month ago now, but at that point, the tariffs on China were over 100%. It was really, really high uncertainty. Not a lot of geopolitical certainty, and it's not saying that now we're at a point where it's completely smooth sailing. But that reading definitely is a little outdated and sort of reflects old news.
Yeah. It's hard to be like forward looking with an indicator like this, especially in this environment where traditionally the reason why this indicator even exists is that the thought is obviously CEOs can oversee their entire businesses and might have a better gauge on their business and the economy than, let's say, a consumer. But with these tariff announcements, I think they were so unexpected and it was such like an extreme level of change and absolute magnitude that no one, whether you're a random Joe Schmo or you're a CEO of a Fortune 500, you couldn't really predict these moves, and you can't predict them. So I don't think it gives that same level of kind of forecasting as it might have in a previous kind of cycle. So just wrapping up here, that is all for this week. Key data to watch going forward. We have a couple inflation readings this week. We have CPI on Wednesday and PPI, the producer price index, on Thursday. Both of those will be really important to watch as they'll start potentially reflecting some of the tariff impacts. On CPI, it's expected to be 0.4%, or let's see, 0.3% month over month. So that's the level to kind of watch. And both of those will also feed into the core PCE as kind of broad inputs. And then we'll also have the Michigan sentiment survey on Friday to give an idea of where consumer sentiment stands. Anything else from
No, I think that covers it.
All right. Thank you all, and we'll see you all next week.